Welcome to Mad Money. Welcome to Cramer. Other people, my friends, I'm just trying to make a little bit of money here. My job is not just to entertain, but to educate, to teach you. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. When the market flies like it's been doing, at least until today, you need to be selective. You have to get more choosy because you don't want to start your buying near the highs. And that is often a license to lose money. So in a day where the Dow tumbled 466 points, the S&P shed 0.34%, but the Nasdaq advanced 0.16%, I want to show you how a professional comes up with ideas in a tape that's roaring and does so without taking on too much risk that we have a quick downturn while attempting to get the maximum reward. You know that sometimes stock picking is all about not coming in on a stock that's already up 30 or 40% this year. Instead, you have to accept that you missed it. Not easy. I'm sure that all of you have one time or another come in on top of a monster move, maybe a Seagate yesterday, SanDisk earlier today, and wish you would exercise some patience because you would have been better off waiting for your pitch. And sometimes it just doesn't happen. Pass. Let's go over first the wrong way to do it. You might have decided on Monday that it was time to own an oil producer because our government now seems to be in control of Venezuela, or at least in control of its petroleum. That was a mistake, an error. You came in near the high, and more important, if Venezuela boosts its production dramatically over the next 18 months, the price of crude is going to get slaughtered. At the same time, the banks are starting to bother me. Now, look, don't be wrong. You know, this group is chronically undervalued. I have praised it many times to you. These are tremendous franchises, but we're headed into earnings season. Do you know that in 6 days, J.P. Morgan reports, I think this, the biggest bank, it's cheap. Stock's way too cheap, actually, 16 times earnings. So why not buy it now? I am worried short term. Because even though CEO Jamie Dimon's a fantastic banker, he's also a really cautious person. He's not going to get on his conference call and crow that his stock's undervalued. He's far more likely to talk about the potential landmines out there. Jamie is a straight shooter. There's nothing bad about that. When things look ugly, he tends to tell you what could potentially go right. When things look good, as they do now, he tends to tell you what could go wrong.
The House of Pain.
I love that. But the media will take the comments out of context, and they're going to present him as an extreme pessimist who's worried about the next credit crisis. Remember his comments last quarter about the blow-up of a subprime lender, Tricolor, and the collapse of First Brands, the giant auto parts conglomerate? Both casualties within the same month of September last year. J.P. Morgan took a $170 million loss on Tricolor, not his finest moment, although it's barely more than a rounding error for the company. Then Jamie, on the call, lowered the boom, telling us, and I'm going to quote, I probably shouldn't say this, but when you see one cockroach, there are probably more. Everyone should be forewarned on this one, end quote. He acknowledged he was tightening his lending policies. And with that admonition, he crushed his own stock. J.P. Morgan stock dropped from $307 to $294 in a couple of days. Many people who bought it in the 300s then dumped it. They panicked. They bought high and they sold low, and that's not what we want here. And it turns out, frankly, that there really have only been those two cockroaches. But he's a cautious man. You know what? He probably doubled down on the cockroach commentary, maybe lob a bomb or two about the future of the Federal Reserve's independence or the lack thereof. Now, that's when you want to buy after he lowers the boom, not up here after you run, even after it did get hammered today on a note of caution by an analyst. So what do? You wait for the reaction to Jamie's cautious commentary to give you a better entry point. And if it doesn't happen, pass. The amazing thing about this stock market is that it's a never-ending source of incredible ideas that can make you grow rich. Now, look, the ideas don't grow on trees, but they're readily available. You just need to know where to look. Take my morning show, Squawk on the Street. Today, my co-host Carl Quintanilla turned to me and asked what looked interesting after so many stocks had run. Now, before I go out there at 9 a.m., I always like to scrutinize the charitable trust portfolio that I run in conjunction with the CNBC Investing Club, which I wish you joined. As I went down the list, and I literally go down company by company, I was astounded to see the stock of CrowdStrike, the best cybersecurity outfit run by George Kurtz, had fallen almost 100 points from its highs in November.
The House of Pain.
I read the most recent research and went over what George told us when he reported last time when he was on our show. I went over what NVIDIA's Jensen Huang said about the company's keynote address and CES on Monday. Do you know that Jensen's been talking about this $10 trillion transformation, the modernization of enterprise computing via AI and accelerated computing? Do you know what he said? He said that CrowdStrike is the secure foundation of this revolution. He praised it several times. And you know what? The stock didn't do anything. I think that's wrong. So I told Carl that this is the kind of stock that rarely comes down this much and is almost never this far from its high. And when it trades like this, what do you have to do? You have to pounce. Buy, buy, buy. The stock was at $464 at the time, and I said it. Finished the day at just under $479. Now, they got a nice price if you bought. I'm definitely, by the way, not telling you to sell it. I'm saying that when you can get a good cost basis like you did in CrowdStrike this morning, you're playing with a very strong hand. Now, let's say we're playing gin. This is kind of like you're dealt a straight and three of a kind. And you got 2 9s with the dealer showing 6 if we're talking about blackjack. It's a terrific way to push the odds in your favor. How about Microsoft? All right, this company's been doing very well, but its stock's been punished by the fact that management wants to spend a fortune on AI. Ever since Microsoft reported its latest quarter, the stock's going pretty much straight down. How often do you get to buy the stock of Microsoft at $485 after it traded at $555 last summer? I know the answer. Not very often. I can go over how NVIDIA or Broadcom are down huge too much, and they're way away from their highs. But, well, then again, I've been recommending them consistently for club members, so there's no real revelation there. So let me give you another one that's on my radar screen that might intrigue you. One that is hated, despised. One that I wrote up in How to Make Money in Any Market as a tremendous company that's become a complicated, unloved stock because it's not tech and it doesn't have great growth. Right now, I'm talking about Procter & Gamble. The Cincinnati Colossus has seen its stock tumble remarkably from $180 in March to $138 today. This is P&G. It doesn't usually have that kind of move. It's a dividend aristocrat. Some people call it a dividend king because it's increased its payout for 69 consecutive years. You're now getting the stock with a 3% yield. I'm not calling the bottom, but it does have a new CEO who has the opportunity to shake things up. Procter's already pre-announced a nasty quarter, and it's one of the few consumer packaged good companies that doesn't have a GLP-1 problem. I got no illusions. I don't think it will necessarily stop at 3%. That's not that high a yield. Many of the packaged goods companies feel 4, 5, 6%. Those are mostly food related. How do you approach it? Okay, let's say you want to buy 100 shares tomorrow. Don't. Only buy 25 shares. Then you wait for it to fall to another level. We yield 3.25, and then you buy another 25. It gets down low to say 4%. Be extremely. That'd be a big move for that. It'd be a big dividend. Big dividend yield. Well, then you can have 50 shares. You have a very nice size position. Slowly but surely, not at one price. Okay, it's not CrowdStrike. It's not Microsoft. It's not Broadcom. It's not NVIDIA. But you can't just have all tech. The bottom line, what you really want are companies with stocks that allow you to take advantage of the magic of compounding and make longer-term gains, not trading gains, longer-term. By all means, own some unloved tech names, but save room for a quality consumer company like Procter & Gamble. It's momentarily down on slug. Fantastic franchise. Amazing dividend that can, after compounding, create great value for you and your portfolio.
House of pleasure.
Mary in California. Mary.
Hi, Jim. This is Mary from Santa Barbara.
How you doing, Mary? What's going on?
I have inherited an IRA. And it's doing really great. My husband was a longtime listener and follower of you, and so everything's doing really great as expected and hoped for. But there's one stock that's a little weird, and that's AeroVironment, AVAV, and I just wonder what you think about the stock. It loses money like crazy, and then it gains money.
Okay.
And
that's true, Mary, but I've got to tell you, you got a lucky break. After the close, we heard from President Trump said he wants to make the defense budget go up dramatically, add like $500 billion. And I've got to tell you something. The stock, which went out at $318 at 4 o'clock, is trading right now at $335, and there's nothing funky about that. That's a terrific company. We have them all the time. All I can say is congratulations. Think about how much money Mary just made. Justin in Pennsylvania. Justin.
Hey, Jim. How are you doing?
I am doing well, Justin. How about you? You're from the East Coast, east part of Pennsylvania, or west?
East Coast.
All right, good. Go Birds. What's up?
So recently I've been watching Celsius closely. The stock has been getting hammered over the last 3 months, dropping from the mid-60s down to low 40s, as investors, are worried about inventory reset and integration risk.
Right.
with a price target of $70. Is the current price around $50 a screening buy, or is that PE ratio still a little too rich for you? Jim?
I write this memo in the morning about 10 things I'm watching. It goes to anyone who's interested in the investing club. And I read this Needham piece. That's the one you're talking about with the price target of 70. And I thought it was a little bit aggressive, but you know what? I think it could put 10 points on because the company's doing quite well and it just closed that acquisition. And by the way, I always welcome Celsius on the show. They tell a great story. All right, listen, by all means, own some unloved tech names if you want to. But what we really want are the stocks that give you tremendous long-term capital gains. Well, remember tonight, as we head into the new year, I'm taking stock of some of the buzziest IPOs of 2025 and seeing where they are right these days. And it's not that great a story. But then there's plenty of potential new names in store for 2026, and they could be huge. I'm going to give you the rundown of the ones I'm watching and how to play them. And with all the uncertainty surrounding oil companies in Venezuela and crude supply, I'm turning to the experts and getting a picture of what to do next when we speak to RBN's Rusty Brazil. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.